Hello, everybody, and welcome to this webinar where we will look at the ocean freight market with an outlook on 2021. I'm joined here today by my colleague, Thomas Sorbo. Thomas, good to see you.
Hi, Patrick. Good to see you.
We're going to be focusing on the market in terms of where it is today and what we see going into next year. Now, housekeeping item here. If you have any questions, please feel free to post them in the questions area in the software, and we will do our best to sort of roll in questions as we go along, but also deal with some questions at the end. Before we get cranking, Thomas, and starting on this, here's the agenda that we've planned for today. Quickly, intro to look at what we do as a business so that it makes sense that we can actually talk about what we're talking about. Look at a little bit at where are we now, and then look at rate and capacity development today and going forward, and then share what you need to know heading into the next year. So that's the agenda. I'm going to get cranking straight at it. Don't want to spend too much time on this intro piece, but it's crucial to understand that Sonera as a business has built up the world's largest database of ocean freight rates, and those are the ones that we're going to lean on today to provide market intel. We also cover air freight, but this webinar is solely dedicated to ocean freight. Now, this ocean freight data is leveraged mainly on 4 areas for our customers. It's the monitoring period, the analyze, budget and planning, and tendering. And this is where our users and customers, whether it's shippers, forwarders, or carriers, leverage the data within those areas. And without any further ado, Thomas, do you want to add anything to this? I know it's quick and dirty, but we're looking to focus on what's going on in the market. But do you want to add anything about what we do as a business before that?
No, I think this is it's a good start, and then we'll come back to the numbers and also why it's so damn important now to have access to sharp intel during the time of year.
Beautiful. So just then, very high level, let's look at where we're now. So we're currently in Q4 2020. There's record high rates in the market. Not for all corridors. We'll talk about that more in depth later. But year over year, east-west capacity has moved from a double-digit decline in the beginning of the year when China shut down to a double-digit increase compared to last year. Now, as for a lot of companies, we're actually not even approaching tender season anymore. We're in the midst of tender season for a lot of big European exporters in particular, and they're facing a very strong sellers market. We see that there's less appetite for carriers from the carrier side to commit to high MQCs. There's speculations here where the carriers want to do lower MQC commitments and then push more volumes onto a very healthy short-term market. We're going to show you guys that in a bit as well. In fact, some of the front haul trades are so bizarrely high priced that carriers are rushing empty boxes back to the origin in order to fill them with cargo on the front haul rather than wait for boxes to be loaded on the back haul, which is to me personally the first time I've ever seen that. First question that's come in now already, asking for whether we will send and distribute a copy of the deck. I believe every sign up will get a copy of the recording, and with that indirectly access to the deck. Main part of the presentation is going to be demonstrated and showed in our actual software. Now, moving on to what we see a little bit going into Q1 is a situation where we expect equipment to remain a shortage. And this is one of the fundamental drivers of the rate increases. And shippers has been firefighting for 6 to 9 months already, making sure they either get equipment or space. We expect Q1 to remain a strong sellers market heading into Chinese New Year at least. And I know There's vaccines now already being distributed amongst the population, but at the same time, we're seeing additional lockdowns. So market's still in flux in terms of the pandemic, and what this year and some of the, let's say, last few years combined with sort of a political unstable environment, especially between China and US, has raised for a lot of our shippers is the topic of single sourcing and whether they should plan for more resilience and have more contingency planning and multi-suppliers in their supply chain to be less sensitive to whether it's, you know, pandemic, political instability, or environmental disasters. So this is definitely something that we see as a topic with growing interest, and now also with some more appetite to put money behind. Another hot topic that's been going on for a while and into Q1 is mode shifting, whether it's air for ocean or vice versa, or actually rail or trucking even from Far East to Europe. So we've seen some bizarre mode shifting events. And I think this gives a little bit of very high level where we are now and a short outlook to next year's first quarter. But what we really want to spend time on today, Thomas, and I'll pass the word here to you, is to look into our actual platform. And the first trade that we wanted to load is Trans-Pacific eastbound. And as you can see here, for new viewers, we're looking at top left, China main ports into US West Coast. And now we're looking at the price development from beginning of 2018 until summer this year, and for the short-term market. So we have not here put the data for year to date for this year, nor have we overlaid the long-term market. And Thomas, the reason why we wanted to do this is to clearly show how volatile the market is. You want to give any commentary to this?
Yeah, I think it's important to say. So what we're looking at, as Patrick mentioned, it's a 40-foot container pricing. So we're looking at an average price here. So this is coming out of our database of the rates that we collect. So you'll see an average development, and as you could see, you know, going back in 2018, you see the increase from the Trump tariffs. So you saw, you know, a rapid increase of rates going up towards, you know, the beginning of 2019, and then it fell down again. And since then, it's been quite stable going up to April, May this year, fairly stable, you could say. And then from there, we've had an explosion, which has been, you know, written all about in the news since that time frame.
Yeah, let me pull that up for you. Here you go. This is then, apologies, this is then the short-term market development, as you explained. It's the same view, right? And now we portray the uptake all the way up here, right?
Exactly. Where it's also been, you know, stabilized now for the last, say, couple of months, around $3,500–4,000 for the 40-foot container. And obviously, reasons for this is lack of equipment and capacity, especially on this route, because a lot of the shippers have fixed allocations. So the space available for the uptake and the demand on the US side has obviously pushed up the rates to all-time high levels.
I think it's worthwhile actually highlighting here that this is the first time ever we've seen a flat development. And this 3,900 mark, when we reached that one, there was immediate reactions from the Chinese authorities that these rates are too high, it's not sustainable. And if they break through 4,000, the carrier, the governments would consider to intervene. And it's interestingly here that collectively the shipping lines have sort of put a cap on it and just concluded that this is a very healthy market for them. And rather than sort of waking more attention to the industry and creating more fuss, they've collectively frozen or stayed on that level. And if you look at this chart historically, that's never happened before. So I raised some serious questions around that. And I know that the European Shipper Council and the US authorities are keeping their eyes on this as well, and also evaluating whether this is sort of pure open competitive market conditions, really.
And I think also worthwhile saying here that, you know, there would be it would be a lot more noise on this corridor if the big shippers would have moved, bigger parts of their cargo at these levels. That would, for a lot of businesses, not be sustainable. So it's going to be extremely interesting to see, how this is going to develop into 2021.
That's a very good point, Thomas. So let me then with that pull up the long-term market. So here's the market development of the long-term market, and I'll pass it to you here in a minute, Thomas, as well. I just wanted to flag that when you look at these combined, it's almost like there's hardly any volatility on the blue line. So I'm going to take away the orange line here for the short-term market and only look at the market development of the long-term market. And here, Thomas, what does this mean for shippers and BCOs?
So I think this is what everybody's asking themselves now. Either they're just started their annual tender for the coming year, or they're preparing for the tender and then asking themselves, what should we expect as a business for 2021? And I think it's also history won't be necessarily the blueprint for the future, but if you're looking at years like 2018 and 19, you had an uptake prior to the contract season in the US, and then it had fallen down to a more steady level as before, so, around $1,400, $1,500, $1,600. So we would, looking into our crystal ball, usually it also shows a bit of a difference, and it tells us, both Patrick and myself, different numbers. So it's obviously it's dangerous to guess for the future, but I would be in the camp where I would think that things will turn more or less back to normal, or what you can say normal prior to COVID-19. And my guess for a 40-foot container, in May next year would probably be around $1,600 all in, based on this. It would be my guess. I'm not sure what your thoughts are there, Patrick.
No, I love this part. I think this is where this industry, nobody has been successful predicting the rates, right? And what we do as a business is show where the market is today and what has been agreed to pay in the future. And long-term contract going into the future now, on average, on Trans-Pacific eastbound sits at $2,100 US, no doubt about that. So that's a substantial uptake. Even when I look at, let's say, December last year, just to get some actual numbers on this, that's a 40% increase year over year. And if it is, as you say, the same sort of pattern going into the tender season on Trans-Pacific, I would speculate that we might see an increase on this high level before it then calms down again. Another element to keep our eyes on is, of course, the equipment situation and whether Chinese New Year bring any relief to that situation. Because if it don't, then I believe that there is a higher chance that rates will actually continue to move up. And with that, I see that there's plenty of questions coming in. I'm just going to pick up one that is super relevant related to this, because it's asking about what are the shippers' approach then to bid season based on current capacity concerns and the high spot market. So, and we have quite a lot of experience with that, Thomas. Can you shed a little bit light of what we see within our customer base?
There's no simple answer to this. Each business, they are evaluating their own what's important, conditions. Are they working directly with the shipping lines, or are they working with forwarders? So we see individual differences. What I'd say is that the ones that have and over years have had close relationships with carriers, have had good volume forecasts, and are in a very good relationship when it comes to these things. A lot of them are pushing forward as planned with their yearly tenders. But we also have, on the other side, we have customers postponing their tenders because they've been uncertain in terms of what kind of rate levels will they achieve during these times. And also some companies are trying to negotiate shorter time frames of contracts, so 3, 6, or 9 months. And then you have the other companies that have seen rates coming in during first round at such a high level that have made them to postpone the entire tender. But I think it's also important to say around this topic is that really depends on what kind of rate level you're coming from. So if you're coming from an extremely low base that some of our large shipper BCOs are coming from, yeah, then the percent increase might be quite dramatic. But if you're looking at, concrete numbers, the increase for maybe the average shipper might not be that extreme. So I think it really depends, and I'm also want to be a bit cautious in terms of how hard we would be beating on the jungle drums in terms of rate levels going through the roof. But obviously it really depends.
Let me add that I think it's also for the first time, Thomas, we see this split between our shippers, where clearly, as you say, some push through and go through this tender season, and clearly somebody has stopped it after like first round and second round bidding and just said, these cost increases are too big for us. We can't stomach them. Hence, we're going to run another RFQ, let's say Q2 or mid next year, and then negotiate these what they call tie over rates. So this is a new dynamic in the market, and clearly very different behavior amongst the shipper base that we have. There's questions coming in, Thomas, on different trades. We will cover some more trades, just so you're aware. There's a few questions here on Asia to Europe and so forth. And then there's another few questions on why haven't the authorities stepped in on the other corridors? And I think I have a good angle entrance to address that question. If you look at this corridor here that we've been looking at now, China Main to US West Coast, the uptake here started in May and over the summer. If we go to the next corridor, South America East Coast, coming from China Main, the uptake started in August. It started later on, but a more aggressive uptake, but literally the same kind of movement that we saw on Trans-Pacific to US, right? And here as well, we see sort of the same, we expect a little bit of the same market behavior, that the short-term market has really spiked, and then slowly the long-term market is following suit, but not with as extreme levels. But if you look at this uptake, I just want to highlight this. If we go here, zoom in on summer period here, July until now, the short-term market is up 571%. We've never seen anything like this, right? These are historical high levels. And when addressing the question about authorities stepping in, I wouldn't be surprised, right? And then just to follow on that question before I let you chip in on these two corridors that we're going to show now, Thomas, this is the European counterpart. This is China main ports to North European main ports. And here the uptake has come in November, December. Yes, it increased before, but nowhere near what we saw on the two other ones until now. And this is a little bit the lag, right? So for Chinese and US authorities, they had more time, and it started months prior to South America East Coast and then to Europe. So this has come sort of after one another, and I wouldn't be surprised if there will be more scrutinizing here from governments to look into this, because clearly it's not ideal for the cargo flow, right?
But I think also, to comment on, the authorities and so forth, we should not forget that it is a small portion of the entire trade which are moved underneath these spot rates. So the majority of the business is moved against long-term rates, which is on a completely different level. If we would be to think about, okay, a scenario where the market for long-term contracts for the big volume shippers going outbound Europe to Asia at a level where we see the spot market today, the noise would be a lot higher.
True. I'm reading a little bit of the questions here coming in, and I think I want to follow up with what you said, Thomas, about the long-term market here. Let's be very specific here. China East main ports, Shanghai equivalent to Rotterdam or Antwerp, North European main ports. You can see the long-term market here at $1,658, while the short-term market has spiked to closer to 5,000. If I remove this and add the lower end of the market, you can see that boxes are still being moved at between this spread, and that's one of the questions coming in. Can you see the lower end of the market, and clearly, of course, we provide that to our customers. and this shows since the initial sort of spike here going IMO 2020 into this year, with long-term contracts going up and then plummeting down as China shut down and more long-term contract was secured. It's been a substantial uptake from that, and those contracts are now coming quickly to an end, and the average increase of that is 25%, whereas the lower end is up 26%. So this is of course available data to our customers, and our expectations is that this will continue, or my expectations at least is that will continue into the new year. There's no immediate relief in sight.
Also, maybe
All
one
right.
thing to mention here, Patrick, because when it comes to the spread, I think it's in times like this, it is crucial to have as a shipper when or a forwarder as well, when you're buying in a market like this, to have access to transparency and to have access to data, because usually in times like this, the spread increases. So it's also a way to be able to make sure that you're getting market compliant rates.
It's a fantastic point. We've seen an increase of uncertainty between whether it's an NVOCC using the data or whether it's a shipper, because the spread increases, so they find themselves in very different places of the market, raising more of a need to have this data to really validate is this a very high or a very low price, right?
And I think it's crucial. So one thing, if when prices go up, it's because of tight capacity, and it's more important to move the cargo and getting the most competitive rate. But really, when the market is starting to slow down, that's really the time where you can make significant improvement as a shipper. Because yes, from a lot of the forwarding communities and carriers, they will not wait to give or to post price increases. But when the market starts dropping, that's really the time to have access to better transparency, better data, so that you can make sharp decisions and really make a difference.
Very good, and that fits very well with our sort of observation of some of the shippers waiting with their RFQ, right? In order to have that data readily available to see, okay, now it's coming down, now the market is going down, now I will consider going back to market again. And another debated approach to this is also whether 2021 should be the year where you run multiple tenders, right? So you do not necessarily commit to a 12-month price anymore, but consider doing a 6-month or a quarterly one, which of course comes with an increased manpower cost to run all of these RFQs. But when you have these percentage increases, the cost increases of running a more active procurement is not necessarily even worthwhile the thinking, right?
And it can really, help make both parties in a contract honest when it comes to, what's going on in the market, what is the fare levels, what is important when it comes to reliability, getting space, and so forth, because that also has a price. So I think it's can be used in multiple different directions in order to really make sure that the boxes are moved and cargo is shipped.
Yeah, there's so many questions coming in. Let me pick a few. One asking for our opinion, Thomas, on splitting volumes between contracted rates and playing something on the spot market. Historically, I know we've entertained that idea of 70% as an example on a contract rate, and then 30% in spot market. Today, there's such a big gap between long and short, which of course raises concerns about being rolled, right? Just purely from a financial point of view. If you sit on a $1,500 long-term contract and the carrier can pick up a $5,000 box at origin, there's a strong incentive for the carrier to roll your cargo. So you have an element of risk there. So in this market, I would argue that it's different, sort of splitting the volumes between contracts and spot market, and very little to gain to put anything on the spot market unless you do that to make sure you get service.
Yeah, and I think that's an important point, Patrick. And I think also you should always remember what kind of signal you send to your suppliers, either if it's a shipping line or a freight forwarder, because if you're acting in an opportunistic way, trying to play the market, that can also fire and backfire, at the different situations. I think, you should really think through the strategy in terms of your procurement approach, and also who you work with, and how predictable you are as a customer when it comes to a lot of these things.
Yeah, absolutely. Listen, our time is flying, Thomas, and I know that we prepared a couple of more trades, and we just wanted to show that everything is not equal or similar on all different trades. And we also know that there's a lot of big European exporters currently running their RFQs. So we wanted to take this corridor as well. Thomas, any commentary from your side on this one?
No, so I think it's been
the lower end of the market here?
Yeah, it's been historically a very stable trade. The last time we saw a spike was during, I think, 2017, when you had the vessel rotation and the alliances being set up, where you had a capacity squeeze out on Europe. That's also what we've seen, during this year. And then the market started to come down during, let's say, August on that time. But now, over the last couple of weeks, month, we've seen an increase due to, again, capacity, shortage of equipment, which is driving the spot market sky high.
It's interesting though to see that if you exclusively look at the lower end of the market here, this is then a 3-year view on the lower end of the market. This is the 2.5 percentile of the market. And you can clearly see that there are big volume players sort of sitting down there with still very competitive rate on a backhaul trade, of course.
Because I think that's important, Patrick. You will have companies paying $200 for a 40-foot container going from Hamburg to Shanghai. And obviously, if you then have a 40 or 30% increase on that rate, that's dramatic in terms of percentages. So obviously, it's, again, if we would look into the crystal ball, what do we think for next year? It's difficult. I'm again, going towards that. I don't think we will see that significant uptake. I think things will stabilize after Chinese New Year. And when it comes to a lot of these negotiations going on in early Jan, Feb, and also March, it's going to be very interesting to see the appetite for volume and also the appetite for market share from the carrier side.
Good point. I like that, especially the market share one. Is there anyone there that's going to be opportunistic and start driving down rates? What I do want to point out from my point of view, because I'm a little bit less optimistic on the shipper behalf, because I think the carriers have been such a bad investment for shareholders for so many years that they now have found sort of a recipe to make good money. And I believe they're going to cling on to that and be very difficult to deal with in terms of making them an asset that's not very attractive amongst shareholders. I have to do one question, Thomas. There's a question here that I know you're gonna like. Somebody's asking whether we would agree that if you make your forwarder or carrier aware that you have this level of data and intelligence, that you can drive behavior to incentivize them to be more proactive in offering reductions or minimizing increases to ensure that they keep the business and avoid potential losses in RFQ. Would you agree to that statement?
Yes, I think it's crucial, and I think it goes with everything. If you have a buyer which is informed and knows what they're talking about, you will achieve better results, in this industry and also in other industries. So I think, and also there's a lot of forward thinking and forward leaning forwarders and also carriers that are open to looking at smarter ways of doing business together. Because let's face it, the tender process is draining for all stakeholders in the industry, and everybody I would assume is looking for stability, predictability, and a reliable partner when it comes to these things.
Yep. All right, excellent, Thomas. We promised to also show an example of something different, right? And this is transatlantic going to the US. Again, all the way back to 2018. So you can see that it increased all the way until summer 2019. if I zoom in on summer 19 and until today, you actually have a market that has moved down with 12% on the short term and 4.5% on the long term. So there clearly is corridors out there that has very different rate development.
Absolutely. This is one example,
right.
and then if you're a customer of Soneta, you can then search and I think it's important to say also you can overlay your own prices, so you have full visibility in terms of what's the market prices and how do you compare against these market levels.
Beautiful. All right, Thomas, I know we're out of time. There is no chance that we're going to be able to answer all of these questions. Let it be crystal clear that within the platform, there's corridors in all directions being covered by the data, long-term, short-term data. This is what we equip shippers, BCOs, NVOs, and carriers, and even consultancies and tech companies with, to leverage in various ways. Obviously, today we talked a lot about tendering and even budgeting can be tied to this, looking into the future and what's happening. I hope you got a few tips in terms of expectations for next year. Any final comment from your side, Thomas, before we leave?
Yeah, we spoke about one thing. We're heading towards Christmas. Huh? You haven't forgotten that, have you? We have 192 people left now in the webinar. So what did we say? Huh?
I agree with you, Thomas. We should be as bullish that if anybody listened to this webinar and mentioned that we said this, they can get a 10% discount on a Soneta subscription for the next year.
So, and also next year, usually, we, like any business, we will be also looking at price increases. So, make use of this. It's going to be a hell of a tender season, and equip yourself with the best information globally.
Thanks a lot for joining, Thomas. A pleasure as always. Thanks everybody for listening in, and we will be sure to share the recording shortly. Thank you.
Thank you, everybody. Bye-bye.